A $5,000 loan, that doesn't sound like much. You could put that on a credit card if you had one, pull it from a home equity line if you owned a house, borrow it from a relative if you had one who could spare it. $5,000 is not a lot of money, but lend that $5,000 the way a loan shark lends it, and it generates $1,000 a week in interest. Every week, $52,000 a year from one borrower. And that borrower still owes you the original $5,000. Because the way this loan works, none of those payments touched the principal. Not 1 cent of it. The borrower paid you $52,000 over the course of a year, and they are exactly as deep in debt as the day they took the money. The thing about loan sharking is that the lender does not want to be repaid. That sounds backwards. Every other business on earth wants to collect what it's owed. But a loan shark who gets repaid has just killed an income stream worth 10 times the original loan. Getting the $5,000 back means losing the $52,000 a year it was generating. So the entire business, every part of it, the way the interest is calculated, the way payments are structured, the way borrowers are found, is designed to make sure that principal never comes back. At its peak in the 1960s, this was the second most profitable operation in organized crime, right behind gambling. Not drugs, not stolen goods, not hijacking trucks or running protection rackets. Lending money and making sure nobody could ever pay it back. Scale that up across a few dozen borrowers, and the numbers get enormous. Almost no overhead, no warehouse, no inventory, no employees beyond a couple of collectors. Just cash out, cash in every single week. How does lending someone $5,000 turn into $52,000 a year? It starts with a word most people have never heard. The word is VIG, short for vigorish. It's the interest payment a borrower owes every single week as long as the loan is outstanding. You'll also hear people call it juice. Same thing. The VIG is the weekly rent you pay on someone else's money. And that's actually the easiest way to think about how this works. Forget everything you know about banks and credit cards and monthly statements for a minute. Think about a landlord. If you go buy a house, you pay the seller, they hand you the keys, and the transaction is finished. The seller got their money, you got the house, and nobody owes anyone anything. That's a sale. But if you rent an apartment, the landlord collects your check every single month, and you never get any closer to owning the building. You could rent for 10 years, 20 years, and at the end of it, you'd own exactly nothing. The landlord doesn't want you to buy the building. The landlord wants you to keep paying rent. A loan shark is a landlord of money. They hand you $5,000, and from that moment forward, you pay rent on it. Every week. The rent is the VIG, usually 20% of whatever you borrowed. On $5,000, that's $1,000 every single week. And just like a landlord, the loan shark is not hoping you'll eventually buy the building. They are rooting against it. Every month that a tenant stays in the apartment is another rent check. Every week that a borrower stays in the loan is another VIG payment. The incentives are upside down compared to what you'd expect from a lender. A normal bank actually wants you to pay the loan off so it can get that money back and lend it out again. But the loan shark needs you to keep paying interest and never touch the principal, because the interest is the whole point. The principal just sits there generating it, same as the apartment building. The landlord holds onto the building and keeps collecting rent. Now here's where the math starts to feel like a trap, because it is one. You cannot chip away at the principal. You can't pay an extra $200 a week and slowly work the balance down the way you would with a car payment or a mortgage. The only way to reduce the principal is to pay it back in a lump sum, the full $5,000, all at once, on top of whatever VIG you already owe that week. And if you had $5,000 in cash lying around, you probably wouldn't have needed the loan in the first place. So the structure guarantees that you stay. The weekly payments are designed to be just small enough that you can keep making them, and just large enough that you can never save up the lump sum to get out. You're trapped by design, not by accident. The person who structured this loan did not make a mistake. They built a machine that extracts $1,000 a week from you for as long as you live, and the only way out costs more than most borrowers can pull together. Walk through 1 year with those numbers. Week 1, you pay your $1,000 VIG. You still owe $5,000 in principal. Week 2, same thing. $1,000 to the lender, $5,000 still on the books. Week 10, same. Week 20, same. Week 52, you've paid a total of $52,000 in interest, and the original debt has not moved at all. The loan shark is sitting on the same $5,000 of principal that they started with. plus $52,000 of your money in their pocket, and the meter is still running. That's the core of the business, not the threats, not the broken kneecaps, not the back alley handshake. The mechanism underneath all of that is the math, and that math is designed to keep you in for good. But here's the detail that everyone missed. That example was one borrower, one loan. A working loan shark doesn't have one borrower. They have dozens. And the way they find those borrowers, keep them paying, and handle the ones who stop is where the real operation starts. If this is already clicking and you want to see where it goes, hit subscribe. This gets a lot more interesting. The street term for the standard rate is 6 for 5. Borrow $5, owe 6 by the end of the week. That extra dollar is the VIG. It sounds almost reasonable when the number is $5. $1 in interest for a week, who cares? But scale it up to a real loan and the math stops being cute very fast. Borrow $5,000, owe $6,000 by Friday. That extra $1,000 is due whether you can afford it or not. And it's due again next Friday and the Friday after that, for as long as you hold the money. 20% per week. If you annualize that the way a bank would report an interest rate, it comes out to roughly 1,040% APR. For comparison, the average credit card in America charges somewhere around 20 to 25% APR. A loan shark charging 6 for 5 is operating at about 50 times the rate of a Visa card. Now, the 6 for 5 rate isn't universal. Not every borrower pays 20% a week. The rate depends on the borrower, the amount, and how desperate they are when they walk through the door. Somebody borrowing $1,000 for 2 weeks might pay 5% weekly, which sounds almost reasonable until you annualize it and realize that's 260% a year. Somebody borrowing $10,000 with no collateral and a gambling problem is going to pay a lot more than that. The operation that the FBI shut down in Philadelphia, a ring run by a man named Illy Gielly out of several Philadelphia businesses, charged rates that ranged from 104% to 395% annually, depending on the borrower and the size of the loan. Gielly and his associates demanded weekly repayments and backed them up with threats and intimidation. He got 168 months in federal prison. That's 14 years. His co-defendant Fatimir Mustafaraj got 147 months, just over 12 years. Both were convicted of racketeering, conspiracy, and extortionate collection of debt. But whether the rate is 104% or 1,040%, the structural trap underneath is the same. You pay interest only. The principal sits there, untouched, generating revenue every single week. And here's the part that makes this a genuinely brilliant piece of financial engineering, if you can stomach calling it that. What happens when a borrower misses a payment? This next part is where the whole thing locks into place. When you miss your weekly VIG, the lender doesn't just mark it late and send you a notice. The missed interest gets added to your principal. Your balance goes up. And next week's VIG is calculated on the new, higher balance. A $5,000 loan with 2 missed weeks of payments doesn't just mean you're behind on your VIG. It means you now owe $7,000 because the $2,000 in missed interest got folded into the principal, and your weekly VIG just jumped from $1,000 to $1,400. You owe more than you borrowed, and you're paying more per week than you were before. The debt grows just by standing still. Every missed payment makes the next payment harder to make, which makes the next one more likely to be missed, which makes the balance grow again. It's a spiral, and once it starts, there is almost no way to stop it without outside intervention, usually in the form of either the borrower finding a large sum of cash from somewhere or law enforcement shutting down the operation entirely. So now you see the landlord model with the walls closing in. The weekly payments are the rent. Missing a payment raises the rent, and you keep paying until something from outside breaks the cycle. The same thing that makes this business so profitable, the fact that borrowers can't pay it back, also creates the biggest problem in the operation. What do you do when someone stops paying entirely? The first thing to understand about the enforcement side is that the movie version of it is mostly wrong. Not because loan sharks are nice people, but because violence is terrible for business. Think about it from the lender's perspective. A borrower who gets beaten badly enough to end up in a hospital can't make payments from a hospital bed. A borrower who dies can't make payments at all. And a borrower whose situation escalates into a police report brings exactly the kind of attention that shuts the entire operation down. Every dollar a loan shark earns depends on the borrower being functional, employed, and quiet. Breaking someone's legs destroys all 3 of those conditions at once. The earliest loan sharks in America understood this perfectly. After the Civil War, a type of lender called a salary lender started operating in cities with large numbers of factory workers. These lenders would buy a worker's future paycheck at a steep discount, which meant the worker got cash today and the lender collected the full paycheck on payday. The newspapers of the day started calling these people loan sharks because they said the lenders operated with the same ruthlessness as predators in the ocean. And the enforcement methods these early loan sharks used were not violent at all. They used wage assignments, which gave them the legal right to garnish a borrower's pay directly from the employer. They used power of attorney agreements that borrowers had signed without fully understanding what they'd agreed to. And they used personal harassment, showing up at a borrower's workplace, visiting their home, talking to their family, making it socially impossible to ignore the debt. The principle hasn't changed much since then. Modern loan sharks, including the Philadelphia ring that drew 14-year sentences, use intimidation, threats, and humiliation far more than physical violence. Showing up at someone's job, telling their spouse, making it clear that the debt is going to follow them into every corner of their life until it's paid. The conviction charges in the Philadelphia case were specifically for extortionate means of collection, which is the federal legal term for using fear and coercion to collect on a debt. Not assault. Not battery. Extortion. Now, customer acquisition. Loan sharks don't take out ads. There is no sign in a window. The way borrowers find a loan shark, or the way a loan shark finds borrowers, is almost entirely through word of mouth in specific communities. Construction crews, restaurant kitchens, gambling circles, especially. Casinos have always been a prime hunting ground for loan sharks because a gambler who just lost his bankroll at 2 in the morning is about the most motivated borrower you will ever find. Immigrant neighborhoods are another reliable source. Communities where people don't have access to traditional banks, may not speak English well enough to navigate a loan application, and may not trust the legal system enough to report being exploited. There was a case in Palm Beach County, Florida, where a loan shark was convicted of charging an undocumented worker an annual interest rate of 180% on a $10,000 loan. He got 24 months in federal prison. If you're wondering how that's even legal, so is everyone else. The answer is that it's not legal, and the reason it went on as long as it did is that the borrower was undocumented. He couldn't open a bank account, he couldn't apply for a legal loan, and he was afraid to go to the police because he thought reporting the crime would get him deported. The loan shark knew all of that when he made the loan. That's the customer profile this business runs on. People who have no other option and no safe way to complain. The operator's real fear isn't that borrowers default. Some always will, and a well-run book accounts for a certain percentage of losses. The real risk is that the operation attracts attention. The FBI investigates loan sharking under federal racketeering statutes, the same laws used to go after organized crime. The sentences are heavy. 14 years for the Philadelphia ringleader, and the investigations tend to sweep up everyone connected to the operation, not just the person handing out the cash. But this wasn't just a street corner operation anymore. The business model, charge interest, the borrower can never escape, make sure the principal never shrinks, target people with no other options, that model didn't stay illegal. It walked into a storefront, got a business license, and changed its name. There are about 20,000 payday lending storefronts in the United States. They operate in 30 states where the law allows them to exist. You've seen them. They sit in strip malls between a check cashing place and a laundromat, usually in neighborhoods where the median income is low enough that the nearest big bank branch is a 20-minute drive away. And the product they sell works like this. You walk in. You need $375, which is the national average for a payday loan. You show the lender a pay stub proving you have a job. You write a post-dated check for the loan amount plus a fee, and you walk out with cash in your hand. The fee is usually about $15 for every $100 borrowed. On $375, that's roughly $56. The loan is due in 2 weeks, on your next payday. 2 weeks later, payday arrives. You owe $431, the principal plus the fee. And here is where the mechanism kicks in. If you had $431 of spare cash sitting around on payday, you probably would not have needed the loan in the first place. So you do what 80% of payday loan borrowers do, according to the Consumer Financial Protection Bureau. You roll it over, You pay the $56 fee to extend the loan for another 2 weeks, and the $375 stays on the books. 2 weeks later, same thing, another $56. The principal hasn't moved. You've now paid $112 in fees, and you still owe the original $375. A month in, and you've paid almost a third of the loan's value in interest alone without reducing the balance by a single dollar. Sound familiar? It should. It's the VIG. That's 6 for 5, just with a different name and a receipt. What comes next is the part that still doesn't make sense until you run the actual numbers. That $15 fee per $100 per 2 weeks translates to an annual percentage rate of roughly 391%. The Philadelphia loan shark ring that drew 14-year federal sentences charged rates between 104% and 395%. The top end of the legal payday loan rate and the top end of the illegal loan shark rate are within 4 percentage points of each other. Those numbers landing that close together is not a coincidence. The math is the same, the scale is the same, and the borrowers look the same. The reborrowing numbers tell the rest of the story. The CFPB found that 75% of all payday loan fees, 3/4 of the industry's entire revenue, come from borrowers who take out 11 or more loans per year. The industry does not make its money from first-time borrowers who pay back once and walk away. It makes its money from people who roll over again and again and again, paying rent on $375 in perpetuity. The landlord analogy from earlier holds perfectly here. The payday lender is running the same model as the street-level shark. Same structure, same incentives. The weekly payment is the VIG. The rollover fee is the rent. The principal sits there generating revenue, and nobody in the operation is rooting for the borrower to pay it off. They don't want the $375 back. If a borrower pays back the principal and walks away, that's $56 in total revenue. But a borrower who rolls over 11 times brings in over $600 off the same $375, more than 10 times the money from the same loan. So, if the math is the same, and the trap is the same, and the customers are the same, you'd think the scale would be similar too. It's not. It's much bigger. Around 12 million Americans use payday loans every year. In 2022 alone, borrowers took out over 20 million individual payday loans, totaling nearly $8.5 billion in lending volume. And out of that volume, storefront payday lenders in the 30 states that allow them drained more than $2.4 billion in fees from borrowers in a single year. That's the kind of number that makes accountants cry. $2.4 billion, not from interest on long-term mortgages or corporate lines of credit, but from $56 fees on $375 loans that were never supposed to last more than 2 weeks. And the borrowers paying those fees are not spread evenly across the population. 3/4 of payday loan borrowers earn less than $50,000 a year. The storefronts themselves cluster in low-income neighborhoods, in zip codes where traditional banks have either pulled out or never showed up. The customer base is disproportionately people who cannot access the traditional banking system, people whose credit scores lock them out of a credit card or a personal loan from a bank, people who need $300 before Friday and have nowhere else to go. This is the same customer profile the loan shark in Palm Beach County was exploiting. People without options, people who can't get money anywhere else, people who are, for one reason or another, unlikely to push back. The loan shark in Palm Beach County went to federal prison for charging those rates. The payday lender down the road, charging nearly the same rates, filed a tax return and kept the doors open. And the way the money flows through the industry makes it clear this isn't a fringe business serving a tiny slice of the population. 12 million borrowers cycling through 20 million loans per year is not a niche market. It is a machine, and it runs on the same fuel the street-level operation runs on. People who need money now and will worry about the cost later. And this isn't just an American pattern. In England alone, the government estimates that 1.08 million people are currently in debt to illegal money lenders. The UK set up a dedicated unit called the Illegal Money Lending Team back in 2004 specifically to investigate and prosecute loan sharks. Since then, that unit has run more than 424 prosecutions, sending people away for a combined 600 years. They have written off over £91 million in debt that should never have existed and helped more than 32,000 people get out from under it. The scale of the problem, even in a country with strong consumer lending regulations, is enormous. Globally, the same structure shows up under different names but with identical mechanics. In the Philippines and parts of India, they call it 5 to 6 lending, named after the same ratio that American loan sharks use. Borrow 5, repay 6. Different language, different currency, different continent, the cultural packaging changes, the math is always the same. So here's the question that hovers over all of these numbers. If a loan shark in Philadelphia charges 395% interest and gets 14 years in federal prison, and a payday lender in Mississippi charges 391% interest and gets a business license, what exactly is the difference? What makes one of them a crime and the other one a line item on a tax return? If you're still here, you're the kind of person who actually wants to understand how money works, not just the version they teach in school. Subscribe and stick around. The answer might surprise you. The answer is paperwork. That's it. That's the line. 20 states and the District of Columbia have interest rate caps at or below 36% APR. In those states, the payday loan model, as we've described it, is effectively illegal. You cannot charge 391% interest in New York. You cannot do it in New Jersey. You cannot do it in Connecticut. The math that works in Mississippi would land you in court in Massachusetts. The exact same loan, at the exact same rate, offered to the exact same kind of borrower, is completely legal in one state and a criminal offense the next state over. That's not a typo, by the way. The legality of this business changes based on geography, not mechanics. And the way it got this way is a story in itself. The original loan sharks, the salary lenders who gave the industry its name back in the 1890s, operated in a country that had strong usury laws. States set maximum interest rates, and anyone who charged above those rates was breaking the law. For decades, state governments and eventually the federal government kept tightening those rules, pushing predatory lenders further to the margins. Organized crime moved in during the early 20th century precisely because legal lending at those rates was impossible. If no legitimate business was allowed to charge 200 or 300% interest, then the only people who would do it were people who were already comfortable operating outside the law. Then the deregulation era hit. Starting in the 1980s and accelerating through the 1990s, state legislatures across the country began carving out exceptions to their own usury laws. Small dollar loans, short-term loans, special categories that sounded narrow but opened the door wide enough for a new industry to walk through. Payday lenders emerged in that gap. They weren't loan sharks. They were licensed, they were regulated, at least on paper, and they charged rates that would have been flatly illegal 20 years earlier. Congress eventually noticed, or at least noticed it happening around military bases. In 2006, the Military Lending Act capped interest rates for loans to active duty service members and their families at 36% APR. The legislators looked at what was happening in the payday lending storefronts clustered around military installations and used the word predatory in the law itself. 36% was the line they drew for soldiers. For civilians in 30 states, no line exists. Think about what that means for a second. The United States Congress looked at this lending model, studied the rates, studied the reborrowing patterns, studied the customer demographics, and concluded that it was predatory, that it was harmful enough to active duty military personnel, that it needed to be banned by federal law. And then it left the exact same model in place for everyone else. The math Congress called predatory in 2006 is still legal for civilians in those 30 states. Same loan, same rate, same trap, different customer, different level of protection. Loan sharking was never really about back alleys and broken kneecaps. It was always about the math. Charge interest the borrower can never escape. Structure the payments so the principal never shrinks. Target people who have no alternatives and no leverage. That formula is the product. It worked on the streets of Philadelphia, and it works in strip mall storefronts in Mississippi, and it works in immigrant neighborhoods in Palm Beach County, and it works in the 5 to 6 lending markets of Manila. The formula works the same way whether the person running it has a criminal record or a business license. The only variable is whether someone with the power to draw a line has drawn one. 20 states did, 30 states didn't. And in those 30 states, the formula runs exactly the way it was always designed to run, just with better lighting and a receipt printer. So, go back to that number from the beginning. $5,000, $1,000 a week in interest, $52,000 a year from a single borrower who never pays off the balance and was never supposed to. That's not just a loan shark's business model, it's a business model, period. It ran on the streets of Philadelphia until the FBI shut it down. And it runs in 30 states right now with a neon sign in the window and a license from the state. The mechanism is the same. The math is the same. The customer is the same person, standing in the same financial hole, with the same empty set of alternatives. The difference comes down to whether somebody filed the right paperwork. The next time you drive past one of those storefronts, the ones wedged between the check cashing place and the laundromat, in a neighborhood where the nearest bank is a 20-minute drive away, you'll know exactly what business they're actually in. They're not lenders, they're landlords. They rent money to people who have nowhere else to go, and those people keep paying for as long as the operation exists. Tell me where you're watching from in the comments, and if this changed the way you think about how lending works, subscribe. I'll see you in the next one.